The U.S.-China trade war escalated over the weekend, with both sides lobbing fresh tariffs on the other's exports and no trade deal in sight. The United States is now imposing levies on an additional $112 billion of Chinese exports, while Beijing is countering with retaliatory tariffs on $75 billion in U.S. goods. Smart speakers, headphones, and shoes are among the Chinese exports likely to be made more expensive through the U.S. tariffs. Beijing, meanwhile, will hit U.S. crude oil with a 5% tariff. And now that's the first time the commodity has been targeted in this dispute. And of course, this isn't the end of the levies. The U.S. plans to raise tariffs on $250 billion in Chinese exports to 30% from the current 25%. And in December, a further 15% tariff on Chinese cell phones, laptops, and clothes. That will mean that virtually all made-in-China products will be subject to tariffs in the U.S. Now, take a listen to what Donald Trump had to say about the latest escalation.
We are talking to China. The meeting is still on, as you know, in September. That hasn't changed. They haven't changed it. We haven't. We'll see what happens. But we can't allow China to rip us off anymore as a country. We can't allow China to take $500 billion a year out of our country. We can't do that.
Now, for more on this, let's talk to our financial correspondent in Frankfurt, Uli Barths. Uli, what's the reaction so far?
Well, here in the market, it's surprisingly benign. The message from the tariffs will be sending ripples of fear through the Mittelstand here in Germany, through industry throughout Europe and Asia. But here in the markets, it's a relatively calm reception. The DAX, in fact, the market barometer for German shares is treading water elsewhere in Europe. In England, for example, or in Italy, the shares are in fact going up. And in Asia, in the very center of where this conflict is also located, you're actually seeing shares higher in Shanghai. And that's part of the message, too. While because there's such a moderate reaction, there was very positive news from the Chinese economy, from the Purchasing Managers Index that sort of mirrors the sentiment and industry there in business. And that's helping to mitigate the effects of this.
Uli, if the reaction is so mild today, should we assume that that means that there's an optimistic outlook going ahead? Briefly, if you can.
With many people, there is. I talked to a capital market strategist this morning and said, look at the shares here. They're not signaling a recession. They're signaling we're expecting this to come to some sort of solution. Donald Trump, we just heard, there's a meeting in September. People are looking at that in the markets, and they're hoping, of course, that there will be a positive outcome. They know you never know with Donald Trump, but there are a lot of people sitting on piles of money, the strategist said, if it comes to a good end.
All right, Uli Barths in Frankfurt for us. Thank you. Now let's take a deeper dive into this with Gabriel Felbermayr. He's president of the Kiel Institute for the World Economy here in Germany. Gabriel, thanks for joining us. My first question, consumer spending, as we've seen, I believe last week, there were some very, very strong numbers about consumer spending in the U.S. Do we really believe then that these new tariffs, which are focused so much on consumer goods, will change American behavior?
Well, we should not forget that the Chinese currency has depreciated some 14% since April last year. And so imports from China of toys, footwear, textiles and so on have actually become cheaper. And now we have those tariffs that make them more expensive. So on net, the effects are likely to be very, very small. And that, I think, explains the positive consumer sentiment in the United States to some extent.
Now, looking beyond the U.S. and China, how do tariffs like these affect other economies like the EU, Mexico, Canada, maybe?
So there is certainly a fear factor. You know, we see that when Donald Trump talks about tariffs, he's able to act and impose those tariffs, and that imposes a lot of uncertainty on everyone. Investors hold back with their decisions. Exporters think twice before they engage into big contracts. So this uncertainty affects everyone, including German exporters to the world, in particular to the United States, of course. But on the other hand, there is an upside because if the Americans lock out Chinese goods from their markets, there might be an opportunity for European producers. So think about the Huawei conflict. Ericsson and Nokia, European companies might sell more in the United States when Huawei is locked out. So again, it's an ambiguous situation for certain products, certain firms. The trade war actually provides opportunities, but for most of them, it's more than a risk. It's more a risk.
were Trump to lose his re-election in 2020, how easy would it be to undo everything he's done with trade at this point?
You see, I think the key factor here is really uncertainty. Trade policy that has been assumed to be stable for many, many years has become a source of instability. And that will be very hard to be undone. We see that trade policy is used more widely in many more countries, not just the United States. And so the genie is out of the bottle, if you like. And any new president of the United States will have to spend a lot of political capital and a lot of time to get the genie back into it. So we have to expect more trade policy uncertainty even without a U.S. President Trump.
Very briefly, is China likely to be persuaded by these tariffs?
Very hard to say. Everything depends on the political costs of those tariffs. And for the time being, we must say that the Chinese government has engaged into a fiscal stimulus. They can use the currency to buffer the negative effects of those tariffs. If really the economy takes a bigger hit than what we have seen so far, then I guess there will be more flexibility from the Chinese side.
Gabriel Felbermayr, president of the Kiel Institute for the World Economy. Thank you very much.
You're welcome.